As we just told you, the inflation rate cooled by less than expected last month, and that is seen as supporting that Bank of Canada inclination to hold off from a rate cut for now. Let's have a look at the latest data with Andrew Hencic, Director and Senior Economist at TD. Andrew, thank you very much indeed for joining us.
Thank you for having me.
It does look like it was a mixed performance on inflation. Excluding food and energy, for example, prices were up 2.7% from a year earlier, and that was an acceleration from 2.4%. So the inflation dragon not dead yet.
No, not quite. I mean, there was definitely a mixed bag underneath the surface. You know, the top line measure cooled to the 2.2%. Which, you know, was a good thing, you know, with grocery prices come registering a little bit cooler than last month. Gasoline prices also having an impact there. But as you said, underneath the surface, a little bit more of a mixed bag.
And what is fueling inflation right now? We know that economic growth is pretty moribund, only around 1%. The labor market, I know it's not weakening decisively, but it's not that strong. So what is providing price pressures in the economy?
Well, the Bank of Canada gave us some indication. You know, we do have this ongoing supply side disruption with regards to trade. Anytime you have one of these supply side shocks, productivity kind of gets upended a little bit and cost structures change. And then businesses have to decide, you know, how are they going to react to this? Some of those pressures manifest in terms of raising prices for end consumers. And so part of what we're seeing now and part of what they've highlighted is that, you know, we're likely to see some upside pressure on inflation from the supply side transition, and a little bit of cooling in terms of offsetting pressure coming from, you know, the downbeat domestic economy and the labor market. And so you end up in this place where inflation's not as high as it was before, but it's also not cooling, you know, the way that it would otherwise.
So it's supply side inflation as businesses adjust, not so much excessive demand from consumers.
Yeah. In broad strokes, yeah, that's exactly the case. You know, the unemployment rate is, you know, 6.9%. That's not low, and so you would expect, given those conditions, for consumer price inflation to be cooling. Unfortunately, as I said, you know, you're going through the supply side transition that does put upward pressure on costs.
We've heard a lot of commentators talk about this emerging age. Well, it's not emerging. We are in an age of inequality, higher income groups doing better, lower income groups struggling. But I guess there's not much monetary policy on the face of it can do about that.
No, you know, the overnight rate, as they like to say, is a blunt instrument. It applies to the entire economy, and you know, the distributional effects, distributional changes in terms of income and activity are kind of beyond the ability of monetary policy to have any kind of material influence on. And so, you know, our Governor Macklem said as much at his most recent press conference. You know, there's only so much monetary policy can do in this kind of environment. You know, those other questions are best left to government.
And again, on the same theme, Governor Macklem has said, I can't really do much about tariffs and the impact on the economy.
No, exactly. You know, tariffs are the trade disruption. They're the supply side shock. Similar in from an economic sense in terms of the supply side disruptions that we saw, you know, after coming out of the pandemic. Monetary policy can't do much to offset the inflationary pressure coming from those. It tends to mostly affect the demand side of the equation. And so, yeah, to a certain extent, the Bank of Canada's hands are kind of, I don't want to say tied, but they're kind of stuck in the moment. And that's part of the reason why, you know, the policy rate now at 2.25% at the lower end of what they deem to be the neutral range. And they intend on, well, at least they signal they intend on keeping them there, provided the economy evolves as they expect.
Just swinging just away from inflation for a minute, we're seeing the government trying to accelerate these so-called major projects, get rid of approvals. Of course, it's tricky. There's legal implications, not just bureaucracy. But could this make a big difference to the country's slow productivity growth if these projects are built faster?
Well, I mean, that's to the government's point, $1 trillion question. They're looking to catalyze 500 billion in private investment, 500 billion of their own. You know, for the near term, these are still projects that, for the large part, take quite a bit of time to release. I mean, I guess we'll have to wait and see. They're attempting something net new that we don't have a lot of experience with, and I think we're just as interested as everyone else to see how this might play out in the coming months and years.
Would you prefer to see more high-tech related major projects? I don't know, maybe a new technological university in maritime Canada or something like that. A lot of it seems to be resource related, not really related to a tertiary economy.
Yeah, they seem to have chosen a path that does lean towards infrastructure and more traditional drivers of the economic engine. You know, that's a strategic choice on their part. From our lens, you know, we've written about desire to see, you know, enhancements to the competitive environment, reviews of a review of how tax and regulatory policies implemented writ large. We didn't see that in this budget, but to a certain degree, you know, maybe maybe they sense that this budget was more of a stepping stone towards things to come. I can't really speak for them, but you know, we'll see we'll see how this plays out.
Andrew, thank you very much indeed. Andrew Hencic, Director and Senior Economist at TD.